Good morning, ladies and gentlemen, and welcome to the VP PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will notify you by email when these are ready for your review. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Neil Stothard. Good morning.
Thank you very much. Good morning, everybody. I'm Neil Stothard, the CEO at VP.
I'm Alison Bainbridge, Group Finance Director.
We're looking forward to telling you a bit about our results for the year ended 31st of March 2022 for VP PLC, the equipment rental specialist. I will run through the highlights and market and trading review, and Alison will complete the presentation talking to the financial review. This photograph, we say we're an equipment rental specialist. I think it's worth just focusing on this photograph. This is in Gothenburg. It's a large metro contract for our ground force business. You can see this is a highly complex and highly skilled offer that we have, and a great demonstration of how we are a specialist in equipment rental. I'll start with the highlights. We had a material growth in profits of 67% year on year. We're very pleased with that, albeit we realise that this was on the back of a COVID hit and impacted prior year, but 67% is good progress. One of the highlights of the results is the recovery in the quality of earnings of the business. They're back to our pre-COVID levels on return on capital employed of 14.5%. Alison will talk to ROCE in her section, but it is a highlight for us that we're back to the same quality of earnings that we were 3 years ago. In terms of our markets, I talk to these in more detail later, but in highlights, infrastructure strength from HS2 and transmission was good, and the AMP7 water programme and rail CP6 programmes were a bit slower, but they did improve to the end of the final quarter. Excuse me. In general construction, we also saw mixed behaviour going on. Strong repair and maintenance revenues were balanced by weaker new build activity. House building held up well throughout the year, and the international division saw a steady recovery in profits. We invested nearly 50% more in our CapEx in our fleet this year, with an emphasis on lower emission solutions for our customers. We did make significant progress on overall ESG implementation and indeed in technology and our digital innovation across the group in the period. And final highlight would be that we acquired M&S Hire, which was an acquisition we made in the back end of 2021, which gives us good exposure to the commercial fit-out market. And right at the end of the financial year, we acquired the plant and tools fleet of Watkin Jones PLC and entered into a 5-year trading agreement with that company. Headlines, again, we'll talk to these in more detail later, but 14% increase in revenues to 351 million, PBTA to 38.9 million at improved margins, return on average capital employed at 14.5%, a net debt increase of 8.7 million after 59.8 million investment in the fleet. In terms of revenues, we made material improvements in our revenues in these results. We're not quite back to where we were pre-COVID, but we are well on track. I think the final element of the closing the gap to 2019 will come as and when some of the markets which have still been laggards in the recovery, do recover in due course, and I'll talk to that later in the market slide. In terms of profits, after a material and not unexpected drop in profitability during the pandemic, we've shown very good recovery in these results and back to double-digit margins of 11%. Now to the market and trading review. I think understanding the core markets that VP supports is critical to understanding the performance of the business and the opportunity within the business. This slide shows our relative exposures to what we see as our key market areas of infrastructure, construction, house build, and energy. We also have other markets. They include outdoor events, they include aviation, defence, mining, and medical. But for the purpose of this presentation, I'll focus on the top four. In infrastructure, we experienced a positive 12% improvement in activity, with highlights being the engagement on the HS2 contract and also in transmission work. The important rail and AMP markets to VP, and those of you that know VP well will understand that they are an important part of the infrastructure exposure that we have. They were slower than expected during the summer, particularly last year. Pleasingly in Q4, towards the end of Q4, we started to see some of the AMP work come through, and we also saw some of the rail projects that we're involved in starting to pick up as well. In terms of construction, I mentioned about repair and maintenance markets being to the fore, whilst the new build was slower. Private commercial and public residential were weak, and I talk to that at a macro level on my next slide. House building, 4% increase looks relatively modest, but it was a sustained level of demand, and the house building market recovered actually more quickly after the start of the pandemic than perhaps any of the markets we were involved in. So we've been growing from a lower base, if you like, in house build, and we're very pleased with the activity in house building. We're continuing to make good progress in winning new customers in that segment. Energy was also very positive, 26% improvement. That's partially because we've seen our well test activity pick up and also pipeline maintenance work. But the energy numbers spike a little bit because we did a major shutdown at the Valero refinery in southwest Wales at the start of the financial year, which gave that segment a boost. So that's the run through on our core market segments. To try and put some context into our experience on that, I've got four charts here which draw on the Experian UK construction forecast for spring this year. Forecasting at the moment obviously is quite tricky, but these I think are a good representation of how we see these markets as well. On the top line, the new infrastructure chart shows that the impact of the pandemic in infrastructure spend was relatively modest. It did dip, but it was a relatively modest fall, and it's been followed by a sharp recovery in the last 12 months, with the potential for further recovery thereafter. Similarly, in new housing, we saw a sharp drop, but a rapid recovery, and with an ongoing prospect of housing activity continuing to grow into 23 and 24. And in the bottom right quarter, we've got total repair and maintenance. And that again illustrates the fact that maintenance activity picked up very quickly post the pandemic, and the prospects for that segment remain very, very good for us. So they're positives. I think those macro charts reflect our experience at a micro level in terms of businesses' performance. Where the gap, I believe, lies is in the chart in the bottom left quadrant, where new non-residential, which actually started to fall pre the pandemic, post-Brexit, that construction work started to fall away. It accelerated its drop off, and in the 2021 calendar, it has only flattened, as opposed to other markets which have picked up quite quickly. New non-residentials, about 21% in Experian's view, is about 21% of the total UK market. And what that chart's showing is that that's nothing like back to where it was, not only pre-COVID, but also pre-Brexit. And the recovery that's expected is tangible, but relatively modest. And I think that recovery, whenever that may come, is another opportunity for us. We as a business have been obviously diverting our energies towards those markets that are growing, but nevertheless, some form of recovery in elements of new non-residential, which include public non-residential, private industrial and private commercial, would be very beneficial to the group. By way of example, to finish on this slide, new non-residential would include schools, hospitals, leisure and offices. So I think that some of those segments, it is feasible that those are going to pick up in due course, but we're not banking on it. So moving to the group performance, the group delivered 14% improvement in revenue, with 56% increase in profits, operating profits to 43.3 million. The incremental revenue drop through to profit is very strong, and I show that at 36% margin. So that, I think, illustrates the gearing operational gearing impact of the business, which has a number of fixed costs. If we can put more through on the top line, then we can get more profit coming through below. And that, I think, is a key driver to operating margins going up from 9 to 12.3%. And these results, which in our view are very good, have been delivered in a market backdrop, as you've just heard from me, which is not yet back to pre-COVID levels. The UK, which is the main driver for the group's performance this year, similar increments in profitability and revenue, and also in terms of operating margin. I talked about the markets, infrastructure, HS2 and transmission. The businesses within the group which benefit from infrastructure activity such as HS2 transmission include our TPA business, our ground force business. Those businesses that are, and they've both been highly involved in both HS2 and transmission work, as have ESS. But those businesses are also, particular ground force, impacted by a slower AMP programme. We're now coming into year 3 from April of the AMP programme, and we are starting to see more work coming through, and I think that's going to be a positive for us in the coming 12 months. CP6, which is rail, that also is a critical part for Torrent, our Torrent trackside business. Again, after a slow 2021, but the Torrent have seen activity levels pick up, and particularly in the Transpennine upgrade work, South West Wales Core Valley Lines contract, and also just general CP6 activity. Construction, repair and maintenance has been busy, as I said. That's very positive for the likes of Brandon and for MEP. But equally, new build being quieter, the residential sort of flattening off is also means that the likes of Brandon are not as busy in that segment as they perhaps could have been if with a better market backdrop. But that's a latent opportunity. House building, consistent demand, that's been very good for UK Forks. One of the challenges for UK Forks has been that getting new product has been difficult, and that has meant that we've hung on to our fleet a bit longer than we would normally do to make sure that we were able to satisfy customer demand, which has remained very good through that process. Margin improvement illustrates operational leverage, but it also reflects the fact that we're combating inflationary cost increases with price improvements in terms of higher rates. And that's certainly been a success for us in the last 12 months. International, as you can see, smaller activity, but it has made a reasonable recovery. Unlike in the UK, most of the jurisdictions where our international business operates have lagged the UK and Europe in terms of opening up from lockdown. So they haven't had, they're probably 3 or 4 months behind the UK in terms of business getting back to some form of normality as a result of COVID. And therefore, I think in that context, these are very good results for them. I think it will continue to improve as we get a 12-month, hopefully, fingers crossed, 12-month clear window on that. In terms of our airpack rental business, they rely on being able to move operators across borders. Our customers rely on being able to move equipment across borders, etc. So there was an inevitable slowing of that business through the pandemic. But again, as borders that reopen, we're starting to see a recovery in our energy activity. So like any rental business, we have to make sure that our fleet remains in good condition and is appropriate to what customers require, and we continue to do that. We have a very fresh and well-aged fleet. We spent £60 million in the year on new fleet, which is a 50% increase on prior year. This was a mix of growth, backing growth in those businesses which have recovered quickly from the pandemic and securing new opportunities. It also reflects a bit of preemptive investment to try to make sure that we've got the right level of supply for our customers, given that lead times from suppliers have largely extended quite significantly over the last 12-18 months. But nevertheless, that's a healthy investment, which we're pleased with. Within that investment, there's a strong emphasis on eco-friendly products as substitution. We're engaging both with manufacturers in making sure that we are producing the best solutions, which are reliable and do deliver sustainability improvement. And we're also engaging with our customers who are hungry for those solutions. So we're continuing to improve the quality of our fleet in the normal way, but we're also managing to retire a lot of the petrol and diesel powered equipment with battery and solar powered equipment as substitutes. And then the final comment on this slide was capital commitments. We've got 14.5 million of orders at 31st of March for CapEx. That's a bit higher than we would normally have. And that again reflects the fact that we have to order much earlier than we used to do to ensure that we're going to get the delivery of the equipment that we require to run the business. ESG is an important topic for us within the group. We have commitment to Science-Based Targets Initiative, which underpins our ESG or our environmental plan. We have a short-term roadmap, which is at the back of the presentation, which has been adopted within the group and is well understood and being delivered on. I mentioned in the CapEx slide, we've invested in new rental fleet focused on greener solutions. These include solar panel lighting, which particularly used in the rail sector, new charge pod designs which are used on sites, and wide and increasing range of battery-powered tools of all varieties. And finally, starting to build on our fleet of electric compressors, electric telehandlers, and electric mini excavators. 71% of the group's fleet are actually zero emission at point of use. So 29% by definition of our fleet does generate emissions through the likes of petrol or diesel engines, for example. But our target is to continue to reduce that as we can and as the solutions are secured from the manufacturers. Internally, vehicle and property emission reductions are focus. We're looking at lower emission commercial vehicle replacements across the commercial fleet. The company car fleets transition to sustainable vehicles. We have renewable electricity at all our UK locations, and we're installing solar panels at key locations across the country. 96% of our waste is diverted away from landfill. We've also committed to 7 separate UK conservation projects, which are now well established, and with colleague engagement opportunities for people within the business to engage on those biodiversity projects. And finally, my comment on environmental is that sharing resources, which is what we do in the rental market, this concept makes rental actually a fundamentally eco-friendly option because the product is being shared, is a shared resource and not a sole owned resource. My final slide on outlook, we're continuing to deliver market leading quality of earnings measured by both ROCE and on margin. Our new financial year has started well and in line with where we expected it to. We've seen an encouraging pickup in AMP7, which is water, and CP6 rail activity into the new financial year. And HS2 does remain a long-term opportunity for us. Residential construction stable and robust. And then in terms of supply chain, we are encountering delays and there are inflationary pressures out there. But we are having good success in negotiating rental price improvements with our customers, and also obviously continuing to drive cost efficiencies to mitigate the worst of the inflation increase. The labour market remains very tight. Recruitment, as in any business, I think at the moment is much tougher than it used to be. And apart from doing the obvious in making sure that we are paying at the right level, we're also investing in the futures of our colleagues by mobilising more activity in learning and development. And we've developed a completely new programme in that area, which is now underway and very much focused on allowing colleagues to develop and to look at career progression within the group. Our digital roadmap has continued to evolve across a number of our businesses. We launched our new web app in Brandon High Station in January, together with their new website. And we think that's going to provide a useful platform for further growth. I've talked about environmental, but we have got excellent momentum in environmental initiatives, and we are delivering sustainable solutions to customers. We won't be talking any more about the formal sale process announced in April, but we did announce that. And the important message to shareholders is, despite that announcement, it is very much business as usual within the group, and everyone is very engaged in continuing to deliver on our plans, and certainly that is my view of how that's going. So we're well positioned to make further good progress. as we embrace the opportunities and also manage through the inevitable challenges which the current market is casting to us. So that's my piece. I'm going to hand over to Alison, who's going to talk to you about the financial highlights of the results. Alison.
Thank you, Neil, and good morning, everybody. So on the financial review, my first slide will be the financial highlights. Neil has touched on most of the highlights in the course of his presentation, but I will reiterate the fact that we have got a good set of results with a 14% increase in revenue and a 56% increase in profits. Another key measure for us as well is our EBITDA. We generate strong cash flows, and they were up 22% in the year. Earnings per share and dividends, we've had growth in our earnings per share in line with growth in profit, and we are proposing a final dividend of 25.5 pence per share, subject to shareholder approval, and that would make a 36 pence per year full year dividend. This reflects a rebasing more towards a 2 times cover, which we trailed at our interim results, and a more balanced interim final split. There is a large uplift year on year in the dividend per share, but that reflects the fact that we didn't have an interim dividend in 2021 due to the uncertainty caused by COVID-19. And here, this slide chart shows the long-term view of our dividends, and you can see that we have progressively grown our dividends over the years, and apart from the blip, which was caused by COVID, we have grown those in line with that growth in our profitability over the period. And again, a key measure for the group is our return on capital employed. We're very keen that we don't just deliver growth in revenues, but we have quality of earnings. And this is our measure to make sure that we do that both through our organic growth and through growth through acquisitions. I'm pleased to say that we have returned to our pre-COVID levels of 14.5%. As a group, we target 15% through the cycle, and you can see that we've broadly achieved that over the period. And also, I'd like to point out the fact that this is well ahead of our weighted average cost of capital at 8%. Two other features of the group, I mentioned the cash generation. We also have a strong balance sheet, which helps us grow and capitalise on that. Hire fleet is at the largest number on our balance sheet, and Neil's mentioned that we have grown that by 10.6 million during the year by investing 59 million in the year. The other point I'd point to is we have had a reversal of working capital. COVID inevitably meant that we did benefit from a working capital inflow in FY21, and as we've recovered from the COVID pandemic, this has reversed during the year. Net debt, I've got a slide later on that, and cash that increased by 8.7 million, which we see as being marginal considering the size of the capital investment that we made and also the small acquisition that we did as well. Debtor days, I'm pleased to say, has gone down by 1 day. We feel that that's at the right level. We try and balance making sure that we take appropriate amounts of risk so that we can grow and develop the business, but also we keep that well under control. And bad debt write-off as a percentage of revenue is sort of at historic levels, which is the same as it has been for a number of years at around 0.5% of our revenues. Strong cash generation has continued, as I mentioned. EBITDA was up to 88.9 million. I've also referenced the reversal in the working capital, which is due to our recovery from COVID and the large amount of capital expenditure that we've had. So the modest increase of net debt of 8.7 million and the unwinding of the working capital inflows are demonstrated here. My final 2 slides are on our net debt facilities and on our covenants. During the year, we did a refinancing. So we had 135 million RCF, which was due to mature during the period. So we refinanced that. We did that in 2 ways. We'd already had in place a private placement, and so we had a further shelf for that, and we drew down another 28 million. And also we had put in place a 90 million revolving capital facility. So that gives us committed facilities of 183 million. And at the year end, we had headroom of 60 million over that. This fixed debt, I think, puts us in a good place. We have 51% of our facilities at fixed rates, and also there's 5 to 6 years to maturity on those facilities, and the RCF matures in June 2024. And then finally, on our facilities, we have 2 covenants. One is EBITDA interest cover, which has to be greater than 3 times. And you can see that at the year end, it was 10.12 times. So plenty of headroom there. And the other one is that net debt EBITDA has to be less than 2.5 times. And at the year end, it was 1.3 times. So well within our covenants. That's my final slide. So if I do escape, just use that one. We're able to take some questions.
Alison, that's great. Neil as well, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right hand corner of your screen. But just while the team take a few moments to review those questions submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Neil, Alison, as you can see, we have received a number of questions throughout today's presentation. Thank you to all the investors for submitting their questions. If I could please just hand back to you to run through that Q&A tab, and where it's appropriate to do so, if you could please just read out the questions and give your response, and then I'll pick up from you at the end. Thank you.
Okay, thank you. I'll read the questions and I'll let Neil answer them. So the first question is, what trends are you seeing in the market from an inflationary point of view? And are there any supply constraints impacting the business?
Yeah, I did touch on that briefly in the presentation. Yes, the inflation is a challenge, as it is, I think, for all businesses at the moment. We're seeing inflation increase in our the price we're paying for our capex, the fleet. We are certainly incurring increased costs for fuel, transport. And that is a challenge, if you like, that we've not seen for some years. We're mitigating. I think we're doing well against those challenges at the moment. In terms of capex, we are we as a rental company, we've got the ability to spread that increased cost over a number of years. It's not like we're buying an inflated piece of kit that's at an inflated cost, which we then have to sell the following day. We will run that equipment for 3, 5, 7, 9, whatever years, depending on what it is. And that gives us the ability to absorb the impact of that increase in capital cost over time, rather than be presented with an immediate problem. Our way of mitigating that is to negotiate, as I said in the presentation, to negotiate improved pricing with our customers. I think there is a realization and an acceptance within the customer base that these price increases are to be expected, and we are making good progress on that. So I'd say that we are encountering inflation within the business, but at the moment I think that we're largely mitigating the impact of that.
Okay, thank you. Good answer.
Right, yeah.
So with infrastructure and construction at circa 77% of market exposure, will you look to M&A to balance the different segments? Where would your focus be?
Let's read that again. I think the fact that infrastructure and constructions are 3/4 of the business, is not something that gives us concern. The reason it's at that level is because we're comfortable with it at that level. We like infrastructure because it gives more visibility. There's more of a commitment. It is volatile, as I've said before about the infrastructure market. Whilst there is regulatory bodies involved, and there is a commitment there, it doesn't always necessarily happen when you're expecting it. And I point to the AMP and rail comments that I made earlier. And in construction, I think that our exposure to repair and maintenance is balanced against new build, but we're not concerned. The same equipment on new build is used on repair and maintenance. So it's up to us as a business to target those areas where there is growth and possibly at the expense of those areas that we may have historically worked in. In regard to M&A, therefore, I don't think we're looking to build in specifically in, say, house build and energy as the other segments to somehow level the playing field. They're just not as big a markets for us, and we're quite happy with that. I think M&A, which we've not, and just comment on M&A, M&A is something that we've not engaged in particularly much over the last 2 or 3 years, mainly because of the pandemic, but we did make the acquisition of M&S Hire in November, December last year. We also bought Watkin Jones fleet in March. And as I've said on a number of calls, I think that as this year evolves, I think vendors that were thinking of selling and exiting, I think it's quite possible that more of those will come to the fore during 2022 and certainly into 2023, which will create more opportunity. So M&A and organic growth will always be fundamental partners for us within VP in growing the business.
And I'd just add, with the energy sector, that has been very subdued for a number of years. And I suppose there is to a degree, an element that if those markets recover, then there'll be an increase in organic growth in that sector.
Yeah, no, definitely. Okay, that's that one.
Right. So I'll read this slowly. Please may I ask a question on the competitive environment across the various divisions? Does the company hold leading market positions in any of the sectors in which it operates?
Yeah, I mean, the rental market has always been competitive, and I think always will be. I think that my view of the wider rental market is that, unlike after the last recession, where we saw a lot of competitors in difficulty, I think that as we've come out of the pandemic, the market is generally in much better shape. I think there's less propensity of rental companies to try to be all things to all people by investing in lots of different areas. I think that rental companies are tending to stick to what they are good at. There's different models out there, there's different ways of operating, and the fact that they are different, I think, is healthy. It's healthy for customers, it gives customers a choice. We believe in the model that we operate in, but that doesn't make other models irrelevant or wrong. In terms of market positions, that's quite fundamental to VP's structure. That many years ago, when we exited our general plant hire division, one of the key elements was that we felt that we needed to be specialists. We needed to develop strong market positions across all our businesses. And the truth is that we do have leading market positions, and leading might not be number one, but it's certainly in the top 1 or 2 or 3. Pretty well in all the divisions we operate in, either in the UK or internationally. And that's an important and a great strength of the group.
Thank you. Okay, the next question. What ambitions do you have to grow international operations?
So in terms of clearly the international division is somewhat smaller than the UK at the moment. Again, the reason for international is that we like the idea of a sort of 3-dimensional exposure of the group. Geographic is one of those exposures. So having some resilience against the UK economy by having activities both internationally, and I know it is international, but from our point of view, our European activities are actually reported in the UK division, is very important as a resilience against just being strong in the UK market. And overall, if you take into account our European businesses, that's Republic of Ireland, Germany, Austria, etc., that our revenues are about 17% ex-UK. So I think my target some time ago was to get that to above 20%. But in truth, for all sorts of reasons, not least of which the point that Alison made earlier about the energy markets being very quiet for some years now, is that that's held back the ability to grow the international market. So yes, we would like to do more internationally. We're certainly capable of doing more internationally, and that would be both in Asia Pacific and Australasia, but also in mainland Europe as well. And they're the two key geographic regions of growth.
Okay, so we have one final question, which is a good one. So has residual value of equipment increased significantly? Are you booking now a larger gain on the disposal of equipment?
Yeah. So the short answer is yes. Residuals have improved quite well. I think that it's a bit like the used car market. I think it's a very similar scenario where acquiring new is both more expensive, it's slower, and it's less available, and we've seen residuals go up. However, the ability to secure those gains on sale have been deliberately subdued by us, because we would rather keep the equipment on fleet a year longer to make sure that our customers are not let down where they need to rent product. So we are hanging on to some equipment longer than we would have done historically, which is not detrimental to the quality of the business. We will still be able to sell that fleet in a year's time, if that's how long it takes, which it could do, for the supply chain issues to subside. But at the moment, where we are selling equipment, and I think there was 17 million proceeds in these results, so we're not stopping. We're just that we could do more, and historically, had we seen residuals where they are, we'd have probably been doing more selling. But there is a reason why residuals are where they are, and that's because we can't get as much new product as we would like. So gain on sale is holding up well as a result. We could do more in a different market, but at the moment we're hanging on to equipment, and that arguably is slightly subduing our bottom line profitability.
Okay, that's us finished with the questions.
Neil, Alison, thank you very much indeed for taking the time to address all of those questions that came in from investors this morning. And of course, if there are any further questions submitted today, we'll make these available to you immediately after the presentation has ended for your review. And ladies and gentlemen, we'll publish all those responses where it's appropriate to do so on the Investor Meet Company platform, and you'll be notified by email when they're ready for your review. Neil, perhaps for redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, no, thank you. Well, thank you very much for all of you that have been listening in today. I hope that you are more appraised and understand the backdrop to these results. I reiterate, I think they're very good results. I think they're the best in the market. The new financial year started well. We're not back to where we were, but I don't think that's anything to do with us as a business. I think that's about certain of our markets not being back to where they could be. So we're certainly, as I said, well positioned for further good progress in the next 12 months, and we look forward to delivering on that.
Thank you for your questions.
That's great. Neil, Alison, thank you very much indeed for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of VP PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.